This is a recent headline from Bloomberg talking about S&P 500 companies getting estimate cuts for Q3 of 2024. Of course, this is EPS or earnings per share estimate. And if we before we look into that, let's first look at the GDP, the economy, right? This is the Atlanta Fed GDP Now estimate showing that for Q3, US GDP is projected, or in this case, using a mathematical model, estimated to be 2.5%. This is the Q3 seasonally adjusted annual rate. So according to the latest economic projection by the Fed or the FOMC, we can see that the Federal Reserve members are projecting a long-term GDP of 2%. So this 2.5% at Q3 appears to be still good or above the long-term trend. And this chart shows you the earnings estimate for Q3 and how it's declining because on the vertical axis, it's showing you the year-over-year growth compared to a year ago, right? And now the earnings estimate for as the time goes from July 12th all the way to September 27th, right? The S&P 500 earnings estimate went from 7.9% down to the 4.7%. Okay, and it's the weakest in the past 4 quarters. This is an interesting chart from FactSet showing you the S&P 500 Q3 bottom-up earnings per share estimate from June 30th to September 30th. And of course, June is here, September is here. This is the S&P 500 price. That's the EPS estimate in black. And obviously in the black or the dark blue line, the EPS estimate has been downtrending, right? But now the question is, right, why did Bloomberg give us a headline? And why is this thing downtrending? Is this something to worry about, right? Is this something to worry about? I don't think so. I don't think it's too much of a thing to worry about because a decrease of EPS estimate during the quarter, because June 30th to September 30th is the actual Q3 quarter, right? And during the quarter, usually the EPS for that quarter, the EPS estimate is actually supposed to decrease because it's a common thing for the estimate to decrease during the quarter. And according to the FactSet, from June 30th to September 30th, the EPS estimate for Q3 for the companies of S&P 500 declined 3.9%. Okay, so during this 3 months, from this point to this point, declined 3.9%. It's still below the 20-year average decline of 4.1%. But it's larger than the 5-year average decline of 3.3%. But the whole point is this is a natural thing to happen. And at the sector level, we can see what kind of sector are witnessing the EPS decrease, right, from June 30th to September 30th. And this EPS decline is led by energy sector. Right? It's down 19.2%. And then we have materials down 9.4%. We have industrials down 8.5%. Okay. On the other hand, the information technology sector or the tech sector is the only sector that's positive. It's seeing a estimate increase of 0.3%. And number 2, we have communication services with no change, okay, 0%. Let's talk about a different topic, which is global central bank rate cut. Okay, of course, we know September we saw the Federal Reserve cut by 0.5%. It's a larger than normal rate cut. And as a result, we're seeing a lot of global central banks doing the same thing. Okay, this chart shows you the monthly number of global central bank policy rate cut. And September 2024, which is circled over here, was the 4th largest month for central bank policy rate cut since the year 2000. Okay, since year 2000, we had 26 cuts in the month of September. okay, overall. And the last time it was higher than this was during the COVID. That's the March 2020. We had 49 cuts globally in that month. Okay, but anyway, it's showing us that the potentially a there's potential global economic concern in September because the monetary policy easing is meant to support growth. It doesn't matter you're coming off of a 40-year high inflation or not. The act of lowering interest rate is to support economic growth. Now let's share some data from Goldman Sachs. This is their latest weekly prime book flow report for the U.S. equity market, pretty much capturing their institutional investors' trading flow for the week ending in October 4th. Okay, October 4th. So they saw that during the week, they saw the largest net selling of U.S. equities in 6 weeks. Okay, and this shows you the net flow. Okay, we have the long, the short. The black is the net flow. Okay, and this week is the worst net flow, or the most negative net selling in the past 6 weeks. The net selling is minus 1.1 standard deviations over the past 1 year average, driven mainly by short sales. Okay, and pretty much if we draw this line all the way to the beginning of the year, the net flow year to date for U.S. equities, for institutional investors, mostly hedge funds, is down 27% pretty much. Okay, and it's showing us there's an increase of bearish sentiment on the U.S. equities among the hedge fund. Okay, and in terms of macro product versus single stocks, we're seeing that hedge funds are net sold macro products, which includes index futures and ETFs. Okay, they're net sold in the past week, and it's actually the fastest. At the fastest pace since January of 2024, with minus 1.4 standard deviations. Okay, and this selling was mostly driven by short sales with a short to long ratio of 2.8 to 1. Okay, and of course we're seeing some net inflows or net buying of the single stocks. Okay, and on the single stock aspect, it's modestly a net bought at 0.2 standard deviations. And the sectors that saw the most net buying were we're seeing energy, and we saw utilities, and there were communication services, and there's healthcare. Okay, healthcare and information technology. The blue line represent the weak net flow. The net flow of the week. Okay, the most net sold sector we saw consumer discretionary and real estate. And what's interesting is that for energy stocks, right, it's the most net bought single stock sector. Energies, hedge funds begin to buy energy stocks for the first time in 7 weeks. Of course, it's due to heightened geopolitical tensions and rising crude oil prices. If you look at the WTI crude oil futures, for the week, we're seeing the price going up. Okay, and information technology is another very interesting sector. It's bought after a very long selling streak. Okay, so hedge funds are returning to buying information technology stocks after 5 months. Okay, 5 months of net selling. It's driven mostly by long buys and short covering with a 3-to-1 ratio. Okay, and subsectors like software and semiconductors were heavily net bought. Despite the broader buying of the tech sector, the mega cap tech stocks, in this case we're referring it to the Magnificent Seven, or the seven largest tech stock. It's not doing very well, right? It's still net sold for the 9th consecutive week. If we look at this chart, it represents the total U.S. net exposure to the Magnificent Seven stocks, right? We're seeing this, right? It's such a obvious downtrend over here, okay, since the middle of the year, okay? And this is representing 12 out of the last 13 weeks of net selling. Okay, so exposure to the Magnificent Sevens currently at the lowest since May of 2023, which is here, at about 16% of their portfolios for the hedge funds. Okay, it's pretty much telling us the hedge funds, even though it's started buying some of the tech sectors, it's continuing to pull money out of the mega cap, right? The 7 largest tech stocks, mega cap tech. They're pulling money out of there.